Good afternoon, everyone, and welcome to the Miller Value Partners live discussion, January 2024. I'm David Yazdan, Head of Investor Relations for Miller Value Partners. I'm joined by Bill Miller IV, who is Chairman, CIO, and Portfolio Manager at Miller Value, and also joining us is Portfolio Manager Dan Lysik. Today, Bill and Dan will share Miller Value's market perspectives, our views on the current investment landscape, which we believe clearly favors active managers, and we'll get into that. Bill will provide a review of Miller Income Fund and its current positioning. He'll share his update on the firm, and both Dan and Bill will discuss specific investment ideas. Then we'll open it up to Q&A. Regarding the Q&A portion, I'd like to emphasize that we really want to hear from you, our partners and clients. If you have a question, you can click on the Q&A icon at the bottom of your screen, type your question, then press submit. If we aren't able to get to your question on this call, we will address it directly with you after the call. So before I hand it off to Bill, I have one more brief announcement. Tune in to see Bill Miller IV on CNBC tomorrow, Friday, on Closing Bell with Scott Wapner between 3 and 4 p.m. Eastern Standard Time. You can check out our Twitter X feed tomorrow, maybe late morning, where we will post a more precise time for Bill's appearance in that hour. I'm sure Bill and Scott will have plenty to talk about. Let's kick off our discussion with Bill, who will share his views on yesterday's milestone SEC decision, as well as his broader views on the current investment environment. Bill?
Thanks, David, and thanks everyone for your time. Really appreciate your attention and the time, because that's your most valuable resource. So we're going to start with the Bitcoin ETF situation, just because it's top of mind for everyone. Two observations I want to make, and I'm going to end with where we stand now on the technology. First observation is the milestone decision, from my assessment, really came in August of 2023 when the DC Court of Appeals ruled that the SEC's prior rejection of Grayscale's application for an ETF was capricious. That decision is what cleared the way for today's. And actually, if you look at the price of Bitcoin when that decision came out in August, it was about 26,000. And since that time, the markets have anticipated the demand, and they're run up about 75% to the current price today. The other observation I want to make about the decision is that, ironically, despite the SEC's reluctance, it actually counteracts the underlying promise of Bitcoin, which is to be something independent of government control. Because what ETFs do is they centralize the custodianship and the ownership of Bitcoin. Now, with all of that said, what do we think about it now? We're still enormously bullish, not only because of the upcoming halving this spring, which will reduce the marginal supply of Bitcoin entering the market each day, but more importantly, because of the longer-term promise of the technology as the only asset that I'm aware of where the marginal supply or the supply is completely independent of the demand for the asset. And we now have a 13-year track record of increasing demand for the asset. And again, we now have an institutional demand from via the ETFs or accessibility. We also have the marginal supply getting cut in half. This is really important because every bull run in Bitcoin's history has come on the heels of a halving event. Bitcoin miners receive Bitcoin in exchange for verifying transactions. They then sell that Bitcoin onto the open market to fund a lot of their operations, their machinery, all kinds of things. And that marginal supply getting dumped onto the market will be cut in half. So unless you think demand is going to fall drastically this spring, there's one clearing mechanism for that, generally speaking, and that is a higher price. So we're enormously optimistic about not only the price, but the technology longer term, because what it stands for, in our assessment at least, is the promise of a completely new monetary technology that could end up being the future reserve currency of the world. It's a global phenomenon, and it's very early in our opinion still. So it represents an enormous part of my personal financial picture. It represents an enormous part of Bill III's financial picture, and we're still hugely optimistic on it. Okay, so I want to turn the page a little bit here and move on to the markets, which is what we spend most of our time thinking about. Actually, prior to doing that, let me point you to a couple resources because people always ask about this. Two pieces on our website I'd encourage you to read. One, The Value Investor's Case for Bitcoin, which we wrote in 2015. That kind of lays out the long-term conceptual framework for how to think about valuation. At $1 trillion in market cap, 900 billion to $1 trillion right now in market cap, it's still a tiny fraction of all the assets in the world. And so there's a lot of room for growth there from our perspective. The other piece, MicroStrategy, Bitcoin, the mother of all fat tails. We wrote that 3 years ago. That's also on our website. It talks about all the bear cases for Bitcoin and why we don't think they hold a lot of water. Finally, the other resource I'd point you to is the website hope.com. That's done by Michael Saylor and MicroStrategy, and it's a phenomenal collection of thinking around Bitcoin, in-depth research, and all of the stuff that you'd want to understand before purchasing it and joining the movement, as I think of it. So let's turn the page a little bit here and move on to markets. I'm going to start by talking about the Q4 investor letter that just went up on our website yesterday. So we always start by talking about the performance of the fund. Performance in the fund of Q4 was solid. We were up 11.4%. We outperformed the benchmark by 436 basis points. More interesting than the fund's performance, though, was the long-dated government bond performance. Long-dated government bonds were actually up almost 13% in Q4, which actually outperformed the S&P's 11.5% return. Why is that interesting? The government bonds went up double digits and more so than the S&P in the quarter. Well, because every prior quarter in the past 20 years, when bonds did better than what they did in this prior quarter, you saw a coinciding drawdown in the equity market from anywhere between negative 11% all the way down to 22% down. So why is that really interesting? Because it represents a major divergence with history, and that's rare because investors tend to dump bonds or dump stocks to buy bonds when they're scared. This is important potentially from my perspective because it could represent a turning point in market psychology around the persistence of inflation. Inflation is notoriously hard to predict, but if you think about that dichotomy, that divergence in movement, it may mean that the markets are signaling all clear. And so when we look around at other market signals from this quarter, we see a really, really positive backdrop for equities as well as value equities. Let's take a quick look at some of the macro data out there and what the market expectations implied by that, or what some of the market expectations are around valuations in the market. So there's a 2.1% expectation for annualized inflation sitting out there right now in the bond market over the next 2 years. That's down meaningfully from where it was just 9 months ago at 3.4%. The Commodities Research Bureau spot index closed 2023 at the lowest level in almost 3 years. And it's down more this year. Fed's looking to cut rates right now. So we have an enormously easy Fed. So they're very well calibrated, I think, to market conditions. They understand that even though we're still seeing headline numbers that are high, 3-ish% for inflation, they're coming down, things are slowing, the Fed realizes it, and right now Fed funds futures are projecting a 2/3 chance of a cut by the end of Q1. Why is that interesting? Well, it's really interesting because it's the only time in the past 40 years where we've seen potential for a rate cut, or we could see a rate. If they cut rates, it'll be the first time in over 40 years when we've seen a rate cut on the heels of 2 consecutive quarters of GDP growth running at 4.5% or higher. So you have a really strong economy. You've got the Fed cutting rates. You've got inflation coming down. You've got the VIX entering the year at its 12th percentile. So fear, broadly speaking, is low. We're in an election year where people want to keep the music playing. So things are really, really good. It's a great environment for value. Value has historically outperformed when in a strong economic environment. What you saw the past decade was, generally speaking, a pretty weak environment where capital had absolutely no accountability. Rates were at zero. Everyone was shooting for the moon, trying to get these moonshots and these tech companies that had absolutely no profits. Guess what? Capital has a cost again. So companies that produce excess amounts of it and where that's underappreciated, so-called value stocks, that's a really good environment for us. So we're incredibly optimistic about not only the market and where we sit, but also potential change in leadership and where we sit within that context. I'm going to turn it over to Dan Lysik now to provide a little more context on why value sits where it does today and why we're optimistic.
Thanks, Bill. We actually put together a couple of slides similar to the past 2 quarters that we're going to walk through. I'll wait for a second just for those to pop up. So the first slide we have here looks at market concentration, which actually closed 2023 at a new historical high. The chart on the left is the bottom portion, highlights the top 5 by market cap. And if you look at that, it actually started the year at 19% and ended the year at 24.5%. And the Magnificent Seven were up more than 100% for the year, obviously led to this market concentration. The S&P 500 returned 26%. The equal weight S&P was only up 14%. So you actually had a 12 percentage point spread between the two. It's the largest annual performance spread over the past 10 years. The chart on the top of that, if you look at the blue line, that's the S&P 500. The red line is the equal weight relative to the market cap. And the equal weight relative underperformance last year reversed all the outperformance since the COVID 2020 low. And as we highlighted back then, we see a significant opportunity for the market to broaden out over the coming year and over the next couple of years, which we think are going to favor more value-oriented securities. If you look at the chart on the right, it highlights the outperformance of growth stocks last year, along with the increase in market concentration. Value stocks had a decent year, up double-digit returns. The Russell 3000 value was up 11%. However, the Russell 3000 growth was up 41%, and that 30% spread is the second largest, as you can see in the chart, in the past 33 years, again, only surpassed in 2020. So growth stocks actually reversed the significant relative outperformance of value in 2022. On the next slide, we'll take a look at valuation spreads. And here, it's interesting is, let's start with the chart on the right. It looks at value versus growth relative valuation. Large cap values P is a little bit below 15 times. And it's actually a 45% discount to large cap growth. During 2023, growth stocks outperformance was more than half of that came from valuation expansion. The chart on the left is actually really interesting. It looks at the combined weighting of companies that have a price to sales greater than 10 times. Historically, this subset has lagged the market over the long term, and you have points in time where long duration does well, and you'll see that actually increase as a weighting. During the tech bubble, the weighting climbed to over 20% for a short period and went to 27%. And then post-COVID outbreak, we saw another surge in long duration up to moving past 20% again before seeing a correction back in 2022. And that valuation expansion during the past year is very similar to kind of 2099. And if you dig deeper in that group, 70% of that is coming mainly from technology stocks, which again gets back to the concentration we talked about in the prior slide. And if you were to look just at the Russell 1000 growth, that percentage would actually be closer to 35% today. So on the final slide, we want to highlight what we continue to see as a tremendous opportunity that's being overlooked also in the market. Let's start here on the bottom right. Small cap is less than 4% of the U.S. total equity market cap. That's near 2020's trough, and then you have to go all the way back to the 1930s to get a similar level. And I guess we shouldn't be too surprised. Magnificent Seven actually added $5 trillion to market cap in just 2023. So again, getting back to Bill's comments before on Bitcoin at less than $1 trillion, you had $5 trillion come in to just 7 stocks last year for market cap. The chart on the left looks at the Russell 2000 as a percentage of the Russell 3000. It's near an all-time low at 6%. And the upper right chart is relative valuation between small and large, looking at various measures. And the key takeaway from that is that we're currently in the 10th percentile, very similar to early 2000 time period, when again, small cap had underperformed leading into that and then did tremendously well, significantly outperformed. And the relative valuation is when it's closer to 50%, the small cap weight, looking at the 100-year average, should be closer to the red line at the bottom. So again, I think coinciding with the fact that We're low with small cap as a percentage of total equity because the valuations are compressed versus large cap. So again, I think as we look, we think there's two pessimistic views that are taking place on low valuation securities, and small caps are providing a nice opportunity. There's a lot of high teens earning yields, double-digit free cash flow yields in that space. And we think history would suggest that there's significant beneficiaries when the market kind of broadens out. We saw some early signs of that take place in the fourth quarter. And so with that, I'm going to turn it back over to David.
Thank you for that, Dan. And your comments in many ways actually highlight some of the advantages afforded to the Miller Income Fund strategy. And for those of you who are new to Miller Value on the call, the Miller Income Fund symbol for the iShare class is LMCLX. Again, Larry, Mary, Charlie, Larry, X-ray is the symbol. The fund has a flexible mandate to seek undervalued yield opportunities wherever they may be. We can invest across the capital structure and across market cap sizes. It's less confined, in our view, than most other income-oriented funds, which tend to be restricted to larger cap dividend stocks, investment-grade corporate bonds, and other heavily trafficked securities. Rather, Miller Income can be nimble and source potentially more attractive opportunities in less efficient corners of the market. With that, I'll hand it back to Bill, who can speak to the income fund's strong performance over the quarter, likely benefiting from its unconstrained investment approach. Bill?
Thanks, David. As you said, the Miller Income Fund looks to own mispriced yield for the long term. We, the Miller family, is the largest investors in the fund by a long shot. And so going back to Dan's comments around small cap and the ability to be opportunistic, almost a third of the portfolio right now is in stocks with market caps under $10 billion. Again, the ability to be opportunistic really differentiates this fund. And, one of the implications of capital having a cost again is that securities which produce excess amounts of it get more valuable relative to their valuations over the past decade when the world was awash in capital and it didn't mean anything. Right now, our biggest position is AT&T, which we think is worth meaningfully more than where it trades today, low to mid 20s, call it, against a current price of $16. It's a high 6% dividend yield against a 14% free cash flow yield. Why is that valuation compelling? Because it's the same valuation where AT&T traded in the financial crisis. Right now, there's no crisis. AT&T is cutting back on their CapEx and free cash flow is growing. They're using it to pay down debt and buy back stock on top of the dividend. So I think it's a really good example of why we're mainly still in stocks. About 20% is in bonds and concentrated positions where we've done a lot of research and believe we have a differentiated view on what the credit is worth. But again, we have the opportunity to be very opportunistic in the strategy. We're the largest investors in it, and we're incredibly optimistic about what we could do over the long term. The basic framework here is we look at the dividend yield, which right now is a very clean income-only yield on the fund. We're not paying any return to capital. And we think we can get capital appreciation on top of that dividend yield if we can get our position security selections right. One other position which we've mentioned in the past and is one of our biggest positions is Stellantis. Stellantis' valuation today is incredibly attractive. It has an incredibly attractive chart for those that follow that. It has an incredibly attractive management team, which owns approximately 14% of the company. It has no debt, an enormous cash pile, and a high single-digit dividend yield. Kicks off a ton of free cash flow at in the current environment. Obviously, that can change, but the management's buying back stock with that free cash flow and investing in the business. And so these at 1.9 times enterprise value to EBIT and no debt, and most likely going to be selling more cars in 10 years than they do today. We think the long-term risk there is very, very low. So we still think there's meaningful upside. Dan, I'm going to turn it back over to you to talk more about some of your ideas, which, by the way, are also, many of them are in the income fund. We work closely together to do research and source ideas. We may end up at different weights, but we also, but we're doing a lot of work together and finding good things to do. So Dan, let's hear more about what your ideas are.
Yep. First of all, I'm actually going to go back to a name we mentioned in the past, and as Bill mentioned, this one's actually owned in both income and other strategies in the firm. So it's Western Bank Alliance, symbols WAL. Stock had a nice recovery later part of last year. But if you still look at it, it's a very high, attractive quality bank. It's trading at 30% discount on a forward PE basis to peers and a 40% discount to the historical average. Historically, they've traded at a forward PE closer to 13 times. Company has a sizable mortgage business also, which could benefit from recovery with mortgage originations as mortgage rates, move lower over time. And achieving management's long-term targets of high teens return on tangible common equity, you get to normalized earnings per share greater than $10. And if you just look at the historical average valuation, Western has upside potential in excess of $100 a share, currently trading, in the low 60s. For this quarter, I have two picks I want to quickly highlight. One is Gray Television, symbols GTN. It's $9 a share, down from the mid-20s. Largest broadcast company with 90% of their TV stations in number one, number two markets. With that local presence, they do quite well with political advertising, and we know that 2024 is going to be a presidential election year. So again, that should help meaningful with earnings and free cash flow generation this year. In addition, management spent close to $500 million over the past 2 years building out kind of a state-of-the-art television and film studio down in Atlanta. NBC's occupying majority of that with a long-term lease, so that asset flips from being a free cash flow use to free cash flow positive. And so we think, there's potential for in excess of $2 billion in free cash flow in the next 5 years. Stocks priced today at greater than 70% free cash flow yield on the step up in earnings and free cash flow this year with political advertising, and close to a 50% earnings yield. And the long-term debt also, like to highlight, looks very attractive in the low 70s. And then my last name I want to mention is Neighbors. So a contrarian name, Neighbors, symbols NBR. Shares near $75 a share. Stocks down close to 50% over the past year due to weakening commodity prices. And we think domestic rig count's going to be flattish over the coming months. But what makes Neighbors kind of stand out is the international market has been strengthening from a protracted trough, and Neighbors has significant presence here. We think that's being overlooked. Just their JV alone with Saudi Aramco can add, in the next 10 years, 5 rigs a year at about 10 million of EBITDA per rig. That's going to be close to 500 million of EBITDA just from that JV. And management's been focusing all their free cash on debt reduction, eliminating $2 billion since 2018. And their balance sheet has significantly lessened the amount of risk given the level of debt. And near-term maturities are limited. And near-term debt average ending this year, probably net debt will be closer towards 2 times. And valuations near the all-time lows. Enterprise value of EBITDA is 3.5. Market cap's near 1 times cash flow. And their free cash flow yield is greater than 50%. So we think Neighbors, again, wouldn't take much to get the stock actually moving, much higher over time. We see it multiples, so we're proceeding to that. And with that, I think I'll pass it back over to David.
Thanks, Dan. Let's move on to questions and answers. Again, as a reminder, if you have a question, you can click on the Q&A icon at the bottom of your screen, type your question, and then press submit. So wait, the first question is for Bill. Bill, can you give us an update on the firm's recent reorganization and ownership structure and how things are progressing at your organization?
Sure. The deal with my dad stepping back closed in May of 2023. Since that time, there have been an enormous amount of changes, the most obvious of which is you, David, hosting this call. We've had an opportunity to reevaluate all aspects of the business from a clean slate perspective. from our service providers to our team incentive structure to our product structure to how we market. And it's very early, quite frankly. We've got a new website launching in the next couple weeks. We have a new ETF launching in the next couple weeks, scheduled to launch end of this month. I'm enormously excited about that. That should launch with approximately 30 million in assets, and we're going to keep putting more money into it after launch. The idea behind that one, it will be a concentrated best ideas capital appreciation ETF at what we believe is an attractive price point. It will have complete transparency. Tax efficiency will be very high. And we will be the largest investors in it for most likely a long time to come. So we have new products. We've got a revamped website communications process. We have a new incentive structure that aligns everyone's incentives with their productivity. Again, it's very, very early. The whole idea here is to be an active manager that actually delivers on the promise of outperforming. And active management in the whole has not provided a great customer experience. We want to reinvent that customer experience for you all because we are the primary customers. So we're really excited. It's still very, very early in hopefully a multi-decade journey. And we're very optimistic and excited about all of the stuff to come. So yeah, the firm's in a great place.
Well, thanks for that, Bill. I'm excited to be on board as well. The next question is for Dan. Dan, earlier in the call, you talked about how the environment lines up nicely to benefit active managers. Can you elaborate on why you think this landscape may be set up for a multi-year shift in favor of active value investing?
Yeah, thanks, David. I think if you look at valuation spreads between the most and least expensive, you're at their historical kind of inflection periods. There's plenty of value stocks that we've been talking a couple on the call, mid-single digit price to earnings multiple. One multiple move improvement is a high teens to 20% return. The growth universe today, equities with a 1P improvement, you're closer to 3%. And I think if you look back at 2000, 2006, I think that's kind of a similar kind of setup where you have market concentration near peak. So broadening out of the market, valuation spreads move back to historical averages. And during that time, large cap value cumulative returns were 50% above the S&P 500. Small cap value outperformed by nearly 180%, and large cap growth lagged by 35%. And so I think, again, as we've highlighted at different times here, low valuation securities, small cap value, we see a significant amount of opportunity set, and we think that bodes well for the next couple of years for a multi-year cycle.
Great, thanks, Dan. We got a question. I think we may have touched on it a bit as it relates to the soon-to-be launched ETF. But the question is, does the fund have exposure to Bitcoin in any way? So I'm assuming that it might either be the income fund, but maybe it's worth talking about broadly. Maybe that's for Bill.
Yes. Both of our funds, or both the income fund as well as the ETF, will have exposure to Bitcoin, not owning it directly, but through MicroStrategy. So the income fund owns the MicroStrategy convertible bonds, 0.75% of 26. Those are trading more like equity just because they're so in the money at this point, but it's about a 3 and change position percent-wise. And the ETF will have most likely a larger position, a larger allocation to MicroStrategy than that.
Okay, great. Thank you. We have a question, I guess, again for Bill. Can you talk about a recent sale in the portfolio and why?
Yes, we trimmed B. Riley in Q4. we were a little uncomfortable with the concentration of various deals they had done. We thought it changed the risk profile of the bank. I mean, if you think about the bank, it's an investment bank, but it's become more of a private equity firm. When we look at some of the deals they're doing relative to the risk profile, we were increasingly uncomfortable with the risk reward of some of those deals. So we trimmed that, reallocated to things where we felt better about the risk profile and potential upside longer term.
Okay, thank you. This is a quick question. What's the symbol on the new ETF? Do we have the symbol? Is it MVPA?
It is MVPA, stands for appreciation.
Great. Do we have any more questions or? Oh, here's one.
I see one, David. Do I still like BLDR? The answer is absolutely. That's a dominant company. It's effectively the leading supplier to home builders in the United States, which is a major swing factor in marginal GDP production and output. Valuation there is super compelling at a 10% yield, given their competitive position, growth profile, and everything else. We are very bullish on BLDR.
That's great. Well, that looks like that was the final question. And that concludes today's Miller Value Live discussion. Thank you all for your time and continued interest in Miller Value. Remember, you can follow us on LinkedIn and X, formerly Twitter, and also on our website. Again, we welcome your feedback in our effort to improve the Miller Value client experience, to increase transparency and provide accessibility to the key decision makers at Miller Value Partners. Here's to a healthy and prosperous 2024 to all of you. We look forward to updating you again in Q2.